Hello there. Today you are going to hear from a sponsor who is effectively recapitalizing his entire company using real estate crowdfunding regulations. Welcome to the GowerCrowd.com podcast, Real Estate Crowdfunding Syndication in the Digital Age, with me, Adam Gower, your host, and my guest today, Chris Loeffler, who is CEO and co-founder of Caliber, a real estate company based out of Scottsdale in Arizona. Now, I first met Chris when I was teaching real estate investment and finance at Cal Poly San Luis Obispo to graduating students. And I was running 3 separate classes with a total of over 120 students. And the way I'd set it up was that I'd present the same lecture to one class and then move on to another room and teach it to another class, and then on to a third room and teach it yet again to a third set of students. Well, Chris showed up one day and, to my monumental relief, asked if he could do the same thing and tell his story to each of my 3 classes, one after the other. Well, I was delighted when he did that. And even though I heard his story 3 times that day as I guided him from one session to another, it was no less fascinating to hear it again today, as you are going to do. By the way, if you're interested in what I taught at Cal Poly, I ended up committing the entire university course to an online format that you can get access to on the show notes page for today's episode at GowerCrowd.com. It's actually the only course anywhere that teaches how to invest in real estate, crowdfunded syndications that you might find online, and the only one ever taught as an accredited course at university level. And you can get access to that on the show notes page for today's episode at GowerCrowd.com. Now, what Chris is doing that is different from any other company that I'm aware of is that he is selling shares in the operating company that itself holds multiple other real estate services companies, including those that directly invest in real estate projects. Put another way, Chris is using Regulation A+, to get technical for a moment, using it in exactly the way it was contemplated by Congress when they passed the Jobs Act in 2012. Fascinating. So find out right now exactly what he's doing and how he's doing it from Chris Loeffler, founder of Caliber, the wealth management company. Chris Loeffler, what a fabulous thing it is to see you again since I saw you here teaching my real estate investment and finance classes 3 times, one class after another, all on the same day. I learned so much. I could almost recite what you taught them and me at that time about the changes in the world and how real estate capital formation had moved from in-person to online. You are without doubt one of the leaders in the field. And what I would like to know from you today is what matters to you the most today. What is driving your everyday activities? And in this crazy world that we're in now, what are the biggest challenges to getting where you want to be?
So good to see you. I think I look back at that time of teaching some of those classes as probably one of the most fun things I've done in my professional career, which is funny because, you've done a lot, but man, being able to share with kids, and they were all enthusiastic and they wanted to learn, and, hopefully one of them took that and did something with it, that was really exciting. So I think, it's April. We all know the biggest news story is COVID-19, the coronavirus. In Caliber land, what we're dealing with most is playing a little bit of defense, taking care of our existing portfolio. We've got about $500 million in assets now. Many of them are hotels, and so we have the hotels are of course hurting the most next to retail. So we've been doing a lot of things like preserving cash, making sure that we work with our lenders to reduce our different reserves that we need to do, to use the cash to fund operations and debt. It's our intent, based on the structure of our company, to show that everything we've said for the last 12 years since we started this business in late 2008 is true. Meaning that you can build a business in the space of real estate private equity and structure it in a way to survive the next financial crisis and thrive going through it. So I look back at, We set limits on our portfolio, no more than 50 or 60% debt. We don't produce distributions until the assets are producing a significant amount of cash flow and we have significant amounts of reserves. So I think about us at 50% debt compared to our competitors who are running at 75% debt, and they distribute every dime they can, because of course that's what makes the investors happy. I don't know how they're surviving right now. I have no idea, because even at a low debt level and high reserves, we have to be very, very careful with our cash right now. So that's sort of the defense side of my world. You know, at Caliber, every week we actually flip from an executive leadership team standpoint from defense to offense and then back to defense again, just to keep our mindset in the right place. Because what we learned in early 2009 and 10 when we started this business was you have to be in the market, you have to be transactional, and you have to be part and party to every conversation going on in the market to know when the distressed market is coming, where the opportunities lie. And so while we're playing defense with the existing portfolio, we're also showing our clients, hey, we've only raised 10, 20% of each fund that we have in the market right now, which means about 80% of every dollar that gets invested with us in the future is going to be going in to the new pricing regime of the post-coronavirus price, which from early indications is showing major, major opportunity.
Right. Now you're doing a Reg-A, aren't you? Tell me something about that, because this is something you actually turned me on to however many years ago it was. I had to spend a lot of time researching what the heck it was you were talking about then. I do know a little bit more about it now, but tell me, you've got another couple of offerings, don't you, going out?
Yeah, so the way to think about Caliber is think of a very, very, very small version of a Blackstone. We have an operating company that runs the business and earns a profit sharing on our assets and our funds as we perform. And then we have funds, which are all private companies, limited partnerships typically, that the investors typically invest in. So for the first time in the history of Caliber, we're allowing people to invest in the operating business, the parent company, the same company I own stock in. And for a minimum of $2,000, they can go online and invest in our Reg-A offering, and they don't have to be accredited, which is also the first time in the history of our company that we've allowed for that. And what it is, at the end of the day, you know, there's a lot of different terms for it, but it's a pre-IPO offering. It's a pre-IPO offering that allows an investor to buy stock prior to a public listing in a company, and they don't have to be Goldman Sachs. They don't have to be an institution.
So why is it, I got to cut you off. Why is it pre-IPO? A Reg-A, basically, it's, you know, I've heard it termed a mini IPO. I mean, that's basically it's a public offering, isn't it? You're offering it.
It is. You know, it's a offering of common stock that's publicly available. The difference is the choice the company makes on, are they going to list that stock on the OTC, on an exchange, or are they going to list the stock on the NASDAQ or the New York Stock Exchange? If they want to list it on a senior exchange, which is the NASDAQ or the New York Stock Exchange, then they're typically going to go through a secondary transaction, which is what Caliber is doing. And the benefit to that is, if I just take my Reg-A stock and list it online, I haven't gotten an underwriter involved. I don't have anybody that can support the stock in the aftermarket. I'm going to have a hard time attracting analyst coverage. And so, you know, my crowd might buy my stock at $4 a share, but I might list it and it goes nowhere, or it starts to degrade over time because there's no volume in the stock. And so we think a smarter path is to issue the Reg-A first, let our crowd and everybody who's followed us for decades, you know, invest now, and then issue a second offering through an S1, which is basically taking the same document we just got qualified by the SEC, modifying it in some ways and refiling it again, and then doing an underwritten IPO with a traditional investment bank. So we're raising basically 2 rounds of capital, one at $4 a share and an underwritten IPO at a different price that will hopefully be higher than $4 a share in about a year.
Fascinating. Okay, and that will allow you to list on the major exchanges once you do.
Yeah, and so in exchange for the illiquidity of the fact that you're buying this investment now and you can't trade it, hopefully you're getting the upside of coming in early into the company's life cycle. And these pre-IPO rounds get invested in all the time. They just don't get invested in by you and me. You know, we don't have access to this, or at least I'm making an assumption about you. I don't have access to this. So this is one of the first times in, I think, the history of the country where a company with my business model is offering this form of stock.
Fascinating.
It's fun.
So Chris, what I want to know, so that's the mechanics.
Yeah.
And as you well know, nobody buys a single share of anything until the one most important question is answered. That's the WIIFM question, the WIIFM. What's in it for me? So tell me, what is today the value? You're launching this thing in the heat of a major battle. What is the value proposition? What's in it for me to buy your stock?
So the way that Caliber makes money is the value proposition. And once you understand the mechanics of that, you can see how your stock value grows. At the end of the day, we're trying to grow the value of your stock, period. That's what we want to do for ourselves and for every other shareholder. And so the way that we make money is that we earn fee income in about 7 or 8 different income streams every time we raise capital into our private funds. So we have a capital raising engine. The more capital we raise in the different funds that we own, a piece of that capital is basically attributable to us in the form of profit sharing interest and various fees. So last year we raised 90 million. The year before that we raised 50. The year before that we raised 39. So every year we've been able to raise more and more capital, and there are things that have happened at Caliber that fundamentally we hope will increase our ability to raise even more. The more we raise, the more the value of Caliber's operating company grows, and the more the stock goes from $4 to $5 to $6, et cetera. So you're buying into a business that has a business model where you bring in lots and lots of money that is non-dilutive to your stock. And the more we raise over here, the more deals we do, the more successful those deals are, the more you make over here. So what accelerates that process? There's 2 things. One, a further move into alternatives. So the more people become more and more interested in real estate and real estate alternative investing, the more our business model grows. And if you believe, as I believe, that we're just at the beginning of that stage, and that the 74 million baby boomers that are retiring right now looking for income are going to want to buy income property, then that's a good play. The other thing that drives it is cheaper pricing, which allows us to drive better returns and better deals. We're already starting to see that in the market, that because of coronavirus, there are going to be buying opportunities. We're looking at a hotel that we can buy for almost a 50% discount to what we could have bought it for 4 months ago. That you and I know from 2008, that's pretty rare. So we're starting to see that come back. And if you want to be a part of that, there's really 2 ways to do that in the Caliber world. One is by buying stock, and 2 is by investing at the fund level.
Now, your parent company level that you're recapitalizing with this Reg-A, that company also owns shares in each of the operating entities underneath it, right? Mm-hmm. So as those do better, so does the parent company.
Yeah, that's the business model. The more successful the real estate is, the more successful the parent company is, and vice versa, because the better capitalized the parent company is, the cheaper our debt is on our real estate, and the more profitable our projects are without any additional effort.
All right, so tell me something about what you're seeing in the market as far as the operating, because you've got a bunch of different entities. You've got a brokerage, you've got a development company, asset management. I mean, you're a full stack real estate company.
Yeah, you name it, we do it.
So tell me, where are the opportunities and where are the threats to each one of those pillars that lie underneath the main corporate entity?
So on the acquisition side, it's pretty obvious hotels and retail are going to be a nice buying opportunity. And it's unique and special situations. I don't think it's going to look like 2008 did, where we had years and years where people could get in and buy something relatively cheap and figure it out. The banks during that last financial crisis did a lot to create infrastructure in the financial institutions to deal with another crash. So the difference is, while the asset values may crash and there may be people that have to give up their assets or do workouts or whatever, those are going to get processed a lot faster than they did in the past. And only, I think, in my opinion, the insiders who have a lot of volume and are in regular communication with these banks will be able to get access to the deal. deals. I think it's going to be a very different environment. So on the acquisition side, we dropped about $500 million worth of deals that we either had an LOI or escrow or some version of negotiation or diligence, and just walked away from every deal about 2 months ago. And now we've turned all of our effort into reconnecting with lenders, special servicers, bankruptcy attorneys, auction folks, everybody across the planet of the distressed environment. Because if the distressed market does appear, we know that it's going to be a much shorter and tighter window. And if it doesn't appear, we'll go pick up the projects from the past again. You know, they'll still be around in the next couple months. And so we're just trying to position ourselves in that way. On the construction and development side, we're already seeing construction labor pricing is starting to come down. Materials pricing is a little wobbly because the supply chains are screwed up, but we think that those are eventually going to come down as well. And most people are just happy and fortunate to have a job if they do right now. It's a really sad time. So we're from an investment company standpoint, you know, we're doing all we can to help out. We're giving away free rooms in our hotels to nurses and doctors just to give them a safe place to stay. You know, we're keeping our people employed, even though we don't have nearly as much for them to do right now, but we know we will. So we're just kind of weathering the storm on that side. On the brokerage side, there's no transaction activity at all. On the lending side, there's very little activity at all. It's all just negotiations and workouts. But everybody expects probably in the next couple months for the spreads to tighten, which basically means that the loan costs will come down, and the more they come down, the more real estate becomes more and more attractive, and that brings the buyers back.
Fascinating. So there are two areas that I am interested in talking to you about, and that is that you have real estate across a broad range of asset classes, don't you?
Correct.
From hotels across everything. So tell me, of the range, you've talked about hotels and the opportunities there, but tell me about, and retail, but what about other asset classes like multifamily and offices and self-storage and all the other things that I know that you guys touch? What are you seeing happening in those sectors?
We're into, I mean, on a weekly basis, watching what's happening with them. So far, all the multifamily is holding up. We've had a slight uptick in delinquency, but nothing that would cause us to be concerned. One of our multifamily properties has a student component to it, and we were pretty worried about that one. And so far, we've only had, 7 people out of 200 we've had to chase, which is not that much. On the self-storage side, same thing, holding up just fine. People are continuing to pay their bills. We're watching for delinquencies coming into May, because maybe that's when people will start being delinquent, but so far, so good. All of our office is doing fine, except for one building that we're still trying to find a tenant for, but that's just kind of normal course of business stuff. And then we have some retail, but the retail that we have is contiguous to a university. It's kind of like a main street. It's not big box. And so that we're still touring people through, and people are looking to, open stores and stuff, because they see that by the time they get open 6 months to a year from now, they feel fairly confident to move forward. And so that's one side of the equation. On the other side, it could get a lot worse if the government and and the powers that be don't step in to create some relief for the CMBS, CLO markets, mortgage REITs, private equity debt. Basically, all the relief that's been created so far only affects the banks. And so while that's great if you happen to have a bank loan, 80% of hotels are probably funded by non-bank financing. So all the other lenders are where they really need some help right now. And if they don't, what most people don't understand is that a mortgage ends up in one big bond, right? And that bond is probably 5 to 20% hotel, 5 to 20% retail, piece of office, piece of multifamily, whatever. So if 10 to 40% of that bond goes cancerous because those assets can't pay their bills, then the bond's going to have problems. And so I think that I've never seen the level of proactivity coming out of the government so far to try to address these situations. I've been on calls with Congress people and senators and members of the White House, et cetera. And, it's just us, we're not that big of a deal, but they want to know, they want the information from the front lines. And when you talk to them and tell them, hey, I think you should do this, they've said, well, I've heard that from 7 other people and we're taking action. It's pretty impressive, frankly.
Well, so what is it that you do on? What are they responding positively to, Chris?
One is I'm trying to get them to think about how to create an off-ramp so that people who have hotels could refinance their hotels with their 2019 numbers and refinance into a bank loan, which is much more flexible than a CMBS loan or other loans. That would save the bond market and the CMBS loans, and it would also put the hotels in a position to weather the storm and then come back out of this. So that just suggestions like that that we've been kicking up there.
So I was actually going to ask you about hotels. How do you service any kind of debt with an operating asset or an asset that requires cash flow? That just is right. Like hotels, they've gone from basically near zero cash flow and certainly below operating expenses. So they're loss producing entities at the moment. How do you, first of all, how do you even determine that 50% is a good price on an asset that has zero, that is losing money every week?
So I'll give you my my spiel on distressed assets. So in 2009, you have the same problem where you didn't know where the floor was. And so who knew what was a good deal? Well, at some point in time in real estate, there are fundamental floors in the real estate values. And so one of those is, if I can buy something for less than 50% of what it costs to build, then at some point in time, there's an inherent value I can recapture, which is a recapture to replacement value. So that's one of those things. If you know what it costs to build something, then you know what 50% of that is. And if you know your number is below that, then you've got upside. The other is on the income side, which a hotel is harder to predict, but like a rental property. There was a time in 2006 when you could buy a rental property and the rental yield was 2% in Phoenix, right, but the mortgage rate was 5.5%. So clearly you were in an overheated market. And then in early 2009, that yield went from 2% down to up to 14%. And the mortgage rate was still 5%. And so you're saying, wow, there's a spread that is so high that it can't get any worse. And that's even after the rents came down 30% from their highs. And so it's you look at income spreads and you look at value regression to replacement cost. And if you can put those two things together and realize you're getting an outsized yield in a normal market and you're getting a better discount than what it would cost to build it, it's pretty easy to make that decision.
Okay, so that's a fairly technical description of value in distress. You are launching a Reg-A to non-accredited investors, to everybody. You and I might understand what you were talking about for 5 minutes, but how do you explain that kind of sophisticated concept to somebody who has never had the opportunity to invest in real estate before and may not know what a mortgage is? Let's start with that, right?
Right. You know what they do know? They do know what a good story is. They do know the story of Berkshire Hathaway. And so we tell stories and we draw comparisons. Berkshire Hathaway, when it went public, didn't attract any institutional investor interest for years. They basically raised all their money in their stock offerings from what they call retail clients, which is individual human beings that were basically their customers and people that they had connectivity to. Wouldn't you have liked to have been one of the first 10,000 shareholders in Berkshire Hathaway? Right. That's one way to put it. I mean, we have a vision and a plan that is a 100-year vision. We have investors that are investing with us for 10, 15, 25 years at a time that are looking to pass shares down to their kids. And so we have to have a long-term outlook. And because of that, we can draw comparisons to a company like Berkshire that creates value along the way, that never really sells stock. It uses the money from the businesses it owns to buy more businesses and compound the returns. That's the same thing that we do in our model, or very similar to what we do in our model. So we have a very similar financial model in the stock to a Berkshire Hathaway. We're just a lot earlier stage. So that's one way to think about it. And the other way to think about it is if all this stuff, this technical stuff sounds really interesting to you and you want to be an insider and you want to buy like we do and you want to buy foreclosure properties or go to buy non-just performing debt and that kind of stuff, you can't do it on your own, but you can do it with us. Be a shareholder, own the stock that I own.
What primarily drives your bottom line? Actually, is it the fees that you earn? Is it the dividends that come off the properties you invest? Are you looking for long-term equity growth? Are you looking for income? Just tell me more about the kind of high-level strategic approach to real estate, especially today in this distressed era.
Bottom line, we make enough from the fees to make a reasonable profit margin on the fees and employ our people. And what drives us is when we get an asset to perform and produce distributable cash flow, we start to get a piece of the cash flow. And when we sell it and we make a big profit for the client. So the main decision-making thesis we go through is raise capital, but buy projects that will be profitable. Because if we buy projects that won't be profitable, the fees that we make is not enough to drive real profitability to Caliber. And so that's, that aligns our interest to the interest of our private investors.
Right. So what are what criteria are you looking for? I remember you talking about this when we were standing in front of the class, but I know it's changed as well. So what are the driving criteria for the kinds of deals you're looking at today?
Yeah, it's pretty simple. If we're going to build something new or renovate it and do like a really big turnaround, we want to double the value of our investment every 5 years. And that's essentially saying a 2x equity multiple. So we want to invest $5 million, we want to transform a property, and we want to sell it for a price that gives us $10 million back at the end of the day. That could come through rents, that could come through the sale price, or some combination of both, but it's the same model over and over and over again. In a distressed market, because we can buy so low, we expect that to be 3 to 4 times our money.
In 5 years. In 5 years.
Yeah,
okay.
Every 5 years. If you're flipping, you can do much better than that, but you never know if the flipping environment's going to come back or not. We'll see. But that's what we do. And if you think about my business, the main driver is generating long-term sticky revenue and then big sale prices, big returns over time. The federal government gave us another gift after they gave us the first gift of the Jobs Act. They gave us a second gift 2 years ago called Opportunity Zones.
Right.
We became one of the largest Opportunity Zone funds in the Southwest and one of the largest and most active Opportunity Zone investors in the entire country. And so to put it into basic digestible terms, an investor who has a short-term or long-term capital gain from the sale of any asset. So say they had $1 million stock portfolio and sold it, or they had a building, real estate building that they owned, or they had a business that they owned and they produced a capital gain. If they took that $1 million stock portfolio and sold it, and 300,000 of that was a capital gain, that can be now taken and reinvested at 300,000 into an Opportunity Zone fund. And that allows them to invest in real estate inside certain zones across the country. And we take that and do what we do. We buy buildings, we build them from scratch, we renovate them, we do all kinds of different things to those buildings. And if we grow the value of that investment over time, it's a 10-year program. After 10 years, if that 300,000 is worth 600,000, the investor sells the 600,000 position and pays no tax on the sale, and they pay a reduced amount of tax of their original tax bill. So the tax benefits to Opportunity Zone investing are incredible. It's the best tax incentive that's existed in the history of the country for a long time. And Caliber is one of the best positioned companies to put that to work.
And what kind of deals are you looking for in Opportunity Zones? Because as we all know, taxes, you can't be tax driven, right? You still got to have a deal that makes sense.
Well, that's actually the brilliant thing about this tax incentive. Every other incentive in the past, you would get the tax benefit almost, and then whatever the real estate did was what it did. In order for this tax benefit to be worth anything meaningful, the real estate has to increase in value significantly. So they have to be deals that make a growth in the value. And so we're looking at, right now we're doing a medical office deal that we bought, renovated an old assisted living facility and turned it into a behavioral health acute care hospital, which perfect timing because behavioral health issues are up across the country 20%, unfortunately. And then that's on a 20-year triple net lease at a 10.5 cap. It's a phenomenal deal. We're doing 4 more of those with that same doctor group across the country in different opportunity zones. The first one was in Phoenix. The next one looks like it'll be in Boise. And then we're doing a DoubleTree Hilton hotel attached to the convention center in downtown Tucson, which doesn't open until next year, which is perfect timing. We have apartments that we're building, and we have a mixed-use, adaptive reuse type deal where we're doing some office, some retail, and some multifamily combined. So it's just kind of a smattering of what makes sense. But the thing that ties it all together, it's middle market real estate. It's $5 to $50 million deals that are too big and too complicated for smaller investors, and too complicated or too small for large institutional investors. So they need somebody like us in the middle market that does these $25, $35 million deals.
Chris, do you look at any long-term deals? I mean, you've talked about having a 100-year plan, but you've also talked about the kicker when you sell a deal and make a big profit. Do you not wish you'd have held on to everything you'd ever bought?
Yeah.
And if the answer to that is yes, why are you not applying that same principle now?
We're actually, next month, we launch our Core Plus fund, which is a long-term fund. And it's designed to do exactly that. Not buy and hold forever, but buy and hold. And then when we do perfect that income stream, sell and 1031 the profit into a new income property and do it all over again. That allows us to compound the cash flow for the investors in a way that they can't do on their own.
And investors can stay in and enjoy the benefits of the 1031.
Yeah,
Can they just roll
they're
over?
getting a quarterly, monthly check, and they just get to see the income stream grow over time. Because I think that's what people are going to be looking for.
So I'll tell you what, let's wrap up. It's the end of the day. Let me ask you one final question, if I may. What are, because we sit here, you're launching a new Reg-A offering. This is one of the most extraordinary times for real estate. Your real estate careers, if I remember correctly, was born out of the last downturn. An amazing story that I've heard and enjoyed many times. But what are the biggest challenges today, and what are the biggest opportunities, do you think, as we look at in the the near term, the next 2-3 months, and then the next year, 2 years?
Biggest challenges today by far is going to be the fear in the market around this pandemic, and the uncertainty that's driven from that, and what that causes people to do, what decisions that causes people to make that are not the predictable ones. The predictable ones, like, oh, they're going to work from home more often. That stuff's easy. We've already figured that out. What is the layer 7 of the 7-layer dip that no one has thought through yet? And in my humble opinion, the only way that you are able to adjust to that, because nobody can really plan for this kind of a black swan event, is to be very active in the market, be in constant communication with all participants. And that's what helps you navigate the ship. And, I read a book that I love called The Clipper Ship Strategy, which basically the metaphor is you have to be a clipper ship. You have to move your ship constantly and readjust and tack with how the wind continues to blow. Because when you go through these periods of time, you can't have a 5-year strategic plan. You have to have a weekly strategic plan that changes over very short periods of time. So that is the biggest risk by far, is not seeing the change in the market and not adjusting accordingly. The biggest opportunity is, I think you're going to see a massive transfer of wealth from the older generation to the younger generation, because it's the younger generation right now that's investing heavily, because they frankly don't care what happens in the next year or two. They know that buying an apartment complex and building value in it at a good price over the next decade is going to be how they build their wealth. So, I mean, we're even seeing that with the online investing crowd. The people who invest 0 to 25,000 are investing like crazy right now, and their volume is at an all-time high. The people who are investing 50 and 100,000 or more are holding back. So I think that there's going to be a huge wealth transfer. I saw it in 2008. We were young and smart enough to take advantage of it, but not well positioned. This time around, I'm sitting on top of 500 million in assets, a machine that raises capital and the ability to deploy. I can't wait. I mean, this is going to be a fun opportunity for us because, my worst case scenario is that things don't go poorly and I go back to doing what we were doing before.
Isn't that crazy? I was actually going to ask you if you were actually hyper excited right now, and I can tell from the answer that you are.
I am, but it's a very kind of bipolar emotional experience because my wife is a nurse. So every night I then think about all the people that are hurting from this, all the people that she's taking care of. And it's like, it kills me, man. It hurts my heart to think about what people are going through. So it's a balancing act for every entrepreneur to make your way through these types of times. And make sure you don't lose sight of the fact that a lot of people are not in the same situation as us. So we just thank our lucky stars.
Chris Loeffler, you're a good man. And it's a pleasure, true pleasure to see you again. Thanks so much for being on my podcast today.
Thank you.
That was Chris Loeffler, founder of Caliber, the wealth management company. Now, don't forget to go to the show notes page for today's episode where you can get access to the accredited course that I taught at university. Of course, you got to go to university to get educational credit for it. But if you want to see the course and take the course, it's available for you there on the show notes page. And while you're there on the website at gowercrowd.com, be sure to go and check out all the COVID-19 resources that you have available to you there. There's a lot of information, including actually a discount on our flagship investor acquisition system online master course, right? That's it. That's all on the podcast page at gowercrowd.com. Plus, of course, you'll find links to Chris and his firm there as well. All right, that's it. Thanks so much for listening. And thank you, Chris Loeffler. Good to see you again. It's after that experience there at Cal Poly. That was really a lot of fun, wasn't it? Founder of Caliber, the wealth management company, for your time with me today. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.